The Dow and Nasdaq on track for their 7th straight week of gains. But is Wall Street getting too bullish? Maybe, and it could be a bad thing. The Investors Intelligence Bullish Sentiment Index is at levels not seen since early fall, when stocks were at their highs and just before, of course, the big fourth quarter market drop. So are too many bulls actually bearish? Let's bring in Joe Zidle, Blackstone's chief investment strategist. Joe, it's great to see you.
Thanks for having me.
You're still bullish.
Still bullish. And starting off with that sentiment chart that you just highlighted, I think it's interesting, but that's really a survey. It's asking people what they think. I prefer to look at what people are actually doing, how they're voting with their wallets. And I think when you look at data on mutual fund and ETF purchases and sales, it tells you that investors are still very skittish. From June of 2016, and the reason why I use June as a starting point is because in June of 2016, that's when the 10-year Treasury yield hit 1.35%. That's when fear and skepticism kind of really hit their peak. From that day through the end of January, investors have pulled almost $200 billion out of U.S. equity mutual funds and U.S. equity ETFs combined. Where'd that money go? Over $500 billion went into traditional fixed income ETFs and mutual funds. Over that same time period, by the way, the S&P's up 37%. The Bloomberg Barclays Aggregate Bond Index, the biggest index for fixed income, is up just 3% and change. I don't think investors are too bullish at this point. I think there's still a way to go to recover the correction that we saw in the fourth quarter of last year.
So when you're giving us those very interesting stats on where people have actually pulled their money out of and where they have parked their money in the meantime, does that imply that you think the markets will go higher and there's more room left in the rally because that money will come off the sidelines, as people like to say, and go into equities? And what will cause them to do that at this point versus at other points in the past, like the beginning of 2018 when things were coming up roses?
Right. I would say two things. Number one, I think at some point investors will capitulate and finally embrace this bull market. But number two, the bigger picture is you really don't get like bear markets when people are, afraid and pessimistic. Really, if you think about what ends a bull market, one of the things that will end it, aside from like say an inverted yield curve from too much Fed hiking, but one of the other things that will end a bull market is confidence. It's when investors are all in, like 1999 in tech stocks, when you've got, the internet, you've got the whole new paradigm and all that other stuff. That's when investors were all in, and that will mark the end of a bull market. We're not there yet.
So Joe, first of all, welcome back. And getting this kind of view is a great one because it was so easy for people to come in here and tell you the world was coming to an end. You highlight mid-2016 because we were coming out of this period where we thought a recession was a given, right? It was a growth scare. So we've had that growth scare, except for I don't think we've really priced in Europe's problems. If anything, the data is decelerating in Europe. We look like we could be recessionary in Germany within a couple quarters right now. The Aussie Central Bank last night basically did an exact U-turn on policy, the Aussie dollar off 1.5%. That's a tell on China. We know China's weak. How do you reconcile?
I mean, I think it's a story of bad news equals good news, right? So number one, start with Europe. We saw Italy hit recessionary territory. If there's a consolation to Italy in a recession, it's that they have a lot of experience dealing with it. They've had 3 recessions since 2008. Number two, growth in France also slowed. And number three, Germany barely avoided recession last quarter. Germany, Italy, and France could all end up in recessions in 2019 based on the direction of the leading indicators. That's point number one. So how does Europe respond? I think it forces the ECB back into quantitative easing. The ECB's exited it. They want out. But the conditions in Europe today are as weak as they were back in 2012 when the ECB announced they would do whatever it takes. So you're going to have liquidity from the ECB, point number one. Number two, the People's Bank of China has injected about 2.2 trillion renminbi in terms of stimulus into their economy so far. I think they'll do more. And then number three, the Fed has moved from tightening in 2018 to more dovish and even easing conditions. So step back and look at the conclusion. The major central banks of the world are going to be providing more liquidity in 2019, and liquidity is a type of fuel for risk assets. It's bullish.
So we're back to don't fight the Fed, don't fight central banks. Wow.
100%.
What's old is new.
Yep.
Joe, thank you. Joe Zidle. Wow. Interesting. All right, Karen, what do you make of that?
Well, it's sort of, I guess, we're in an environment there. You're talking about what's bad news is good news, right?
Goodbye the guest.
What?
Be careful.
Yeah.
Be careful.
I was pointing to Pete. Oh. He says that. What's bad news
Nice
is good
recovery.
news.
Bravo.
He always talks about
I do. I bring that up every day.
ECB
That kind of
and
guy.
policy, and that's really his thing. But no, I get what you're saying. It's an interesting argument. I'm bullish as well, but I do think it's time to buy protection. Right?
So I would agree with that. I think the one thing, if I'm going to push back on any of it, is this money that's gone out of the stock market. Demographics might play a role here because you have a whole swath of baby boomers who got frightened by this sell-off and may not come back into the stock market. So that, if you want to take the bearish view on it, that's probably the bearish view. But again, until central banks decide that they no longer want to print money, then the stock market has potential to go up.
I still think that if there's any kind of deal, any kind of progress, we continue to move to the upside. But that big hiccup, when that comes along, we've got an issue.